It's important that you're able to identify your model in the markets and execute on it with no hesitation or fear. But it's of equal importance to be able to leave the markets alone when you have to. If you don't know when to stop trading, it's highly likely you'll run into a losing streak that's unnecessarily long that has the potential to blow your account. So today I'm going to be sharing with you the market conditions I personally avoid to protect my capital so that you can do the same. So let's get into it. So there are three main scenarios where I'll sideline myself and wait for extra confirmation. But before we get into those, I think it's important for you to understand what my ideal trading conditions are. So essentially, I'm either going to be targeting external or internal range liquidity. If you don't know what that is, then external range liquidity is old highs and old lows, and internal range liquidity is FVGs and other inefficiencies. So the ideal conditions for me is, first of all, I have a clear external or internal range liquidity target, right? I like to have a clear target I'm expecting price to trade towards. And not only that, the other thing for my ideal conditions is that we have a clear buy program forming towards that target, right? Or if I'm bearish, I have a clear sell program forming towards that target. What's a buy program and what's a sell program? Well, a buy program is simply the way that price moves to the upside. So I want to see price forming and respecting bullish PD arrays. So FVGs and order blocks, I want to see bullish arrays like that holding towards my target. And then a sell program is the same thing but opposite. I want to see price holding and respecting and forming bearish PD arrays towards my target, right? So essentially I want a clear target and I want price to be forming clear bullish or bearish order flow towards that target. So the first example of this here on gold, weekly's bullish, we have this FVG here. That is internal range liquidity, okay? And if I go onto the daily, you'll be able to see that price trades into that internal range liquidity. So from there, because the weekly is bullish, I would anticipate now a reaction from the internal to target this high up here, which is external range liquidity. So I have the clear target, okay, but for my ideal conditions, I need to see bullish order flow forming towards that target, or a buy program forming towards that target, because I'm not just trying to catch the low, right? Because it is the buy program moving towards a target that tells us price is moving in favor of the target. You know, a target is simply a prediction, and you know, once you get that buy program moving towards the target, that is more of a confirmation. So essentially, once price was building bullish order flow, so these last down candles that got closed above, that formed a bullish order block. We also have this inverted fair value gap here. You can see that got respected. So as price is forming and respecting these bullish PD arrays towards the external range liquidity target, that is my ideal trading scenario, right? That's my ideal conditions. Okay, so a bearish example now on Euro USD. Price retraced into this FVG. That is internal range liquidity. So from there, I would anticipate a movement towards external. So we have this old low here. That is external range liquidity. And we also have this low here, right? We have a couple of lows, both of them classed as external range liquidity, right? So we have the external range liquidity target. Now, for the other criteria for my ideal conditions, I want to see a sell program moving towards this external range liquidity, right? So forming and respecting bearish PD arrays is what I want to see. You can see we swept out this old high, and then price closed beneath these two or these three up candles. Maybe you class these two up candles here as the order block. Either way, we're now forming a bearish order block. So, you know, we're in a sell program. That's that bearish order flow. So once we form that, I'm now in the ideal conditions. I have a clear target and price is clearly moving towards that target. So that's the type of conditions I want to trade in. As you can see, that held and price reached for the external range liquidity. Okay, so that's the conditions I do want to trade in. Now let's get into the first scenario where I'll personally sideline myself. Now this one is once we reach the major liquidity target, right? So let's say, for instance, we have an external range liquidity target or internal, and once we reach that, there aren't further targets past that we're expecting price to get hit. So this could be whether you're at all-time highs or you simply just don't have a higher time frame draw once your target gets hit, right? Same for bearish. Let's say we reach a bearish level of external range liquidity. There is nothing past that level that we're currently looking for price to reach for. I will sideline myself, right? Because you now don't have a draw on liquidity past that level. So there is no reason as to why price should continue to hold that order flow, right? Price could simply just reverse on you because, you know, you don't actually know where price is going next, okay? So essentially what I'll be looking for in these scenarios, first of all, is a potential reversal, right? So potentially this buy program here switches completely, and now we have to go and look, you know, is there a bearish target that this newly formed sell program is going to run to? The other scenario is, are we going to get a retracement and then potentially price will form like a market maker buy model? And once we start to form the buy side of the curve, right? So let's say we get this retracement and then we get a CSD down here and price starts to build bullish order flow. Let me get this out of the way. And price starts to build that bullish order flow. Okay, that in itself can be confirmation that price is still going to run to the upside, right? So you can use that. But the point is, we're not executing up here. We're waiting to see if we get that retracement. And once we do, you're still waiting for that to turn around and start moving to the upside before you engage. Okay, because you have to wait for the evidence that price is continuing, because you don't have a level for it to reach for. But once we do start to form the buy side of the curve, right, this old high now becomes another external range liquidity target. So if you still don't know if there's a level over here for you to reach for, this has just formed a level of external range liquidity that you can trade towards as per this market maker buy model. So that's if price was in a buy program, right, and it's reached its bullish target. Now, let's say price is in a sell program, right? You've been trading on the higher time frame to the downside to reach for some kind of higher time frame external or internal range liquidity target. But then we reach that target and there's no other levels down here that you're currently anticipating price to reach for. Again, that could be at all-time highs, well, I mean, all-time lows, or it could be at, you know, just a level on the higher time frame where you don't know if price is going to continue after that. So in those scenarios, like I say, you're going to wait for more information. Regardless of whether price continues or reverses, every time you're waiting for more information because you no longer have a clear draw on liquidity, okay? So in that scenario, again, you want to see, does price completely reverse this sell program? If it does, do you now have a target for the newly formed buy program? Okay, again, just because it's reversed doesn't mean you start buying if you don't have a target, right? Because the criteria for the ideal conditions is a clear target and a buy or sell program moving towards it, okay? So even if we reverse, you want to be able to identify some kind of level that price is going to travel towards. Otherwise, you know, again, low probable conditions. But yeah, that's one scenario, that you get the reversal. The other scenario is that that reversal is actually just a retracement, and you'll know if it was just a retracement because price will start to form the sell side of the curve again, right? You'll get a retracement and then that will switch back to a sell program, right? Will form some kind of bearish array. And once that sell side of the curve begins, you can start to engage again, right? Because now you have this old low as an external range liquidity target and the sell program here is moving towards it, okay? So that's the first scenario. So this first example is on gold and we're on the weekly because I want to show you where we are, right? Price is at all-time highs. There are no targets over here on the left, and that's important context for the example that I'm about to show you, right? So if we go now onto the daily, or even if we go onto the 4 hour, okay? So I personally had a draw, and I'm pretty sure I called this draw out to the free Discord, to this external range liquidity target. Okay, if I rewind it back to here, I had this as an external range liquidity target I expected price to reach for. We were forming and respecting bullish arrays because price respected this gap here. Okay, we respect the gap, then we respect this FVG. So that is a buy program, right? It's a buy program headed towards a clear level of external range liquidity. So those are ideal conditions, right? Ideal trading conditions. But then once we reach this external range liquidity, what target do I have? Right? You no longer have a target because price is at all-time highs, right? We don't have any levels over here on the left, and we've taken out the main liquidity target. So you don't have anything for price to reach for. So you have to sit on your hands and you have to wait for evidence that price is either going to continue or it is going to reverse. Now, you may have noticed here, we actually got a little continuation. So price retraced under this liquidity here. Okay, price retraced and we took out this low. So we had a retracement and then the buy side of the curve came back in. Okay, price formed this bullish order block and then price, formed this order block here. I personally wouldn't engage down here simply because, I wouldn't be convinced that price, is actually moving towards this high up here. But once we're over here, okay, and we're starting to get in closer proximity to this high, you can be confident, right, that this was just a retracement for price to continue. All right, so this next example is on DXY. We had this old high up here as the most major level of liquidity that was available for price. There's this old high up here, but that is so far away. You're not going to say, oh, I'm just going to continue to buy because of this level. Look how far away it is. It's further than this leg had to go to get here, right? It's miles away. So you reach that level of liquidity and now, there's not really anything to reach for after that. So you wait, okay? You sit on your hands, you sideline yourself and wait because you no longer have that clear level of buy side liquidity, right? And if I play it out, what happens? Price retraces into internal range liquidity, right? I'll rewind it a little bit. Price retraces back to internal range liquidity, right? We took out the old high, which is external, and then we retrace to this internal level, okay? This weekly FVG. So once we've retraced to that internal range liquidity, potentially, now you're like, cool, we can still go and target this external because the weekly is still in a buy program, right? We're still forming and respecting bullish arrays. And now we have a clear level of liquidity price can reach for. But before you actually engage, you want to see a buy program forming towards that level of external range liquidity. Okay, so that's the other thing that I would personally wait for. I'd still be sidelined. If I play it out, you can see here, price forms this bullish CSD, right? We close above these last 3 down candles. That's a bullish order block. For me, now we're forming that buy side of the curve, right? We had the sell side, the retracement into the internal. Now we're forming that bullish order flow. Now you can be confident in the market conditions again because you have that target and you have the buy program. So then you can target the external and price hits it. Okay, so the second scenario where I will sideline myself, I was going to do a whole section on it, but now I've shown you these examples, I feel like I can just cover it quickly because I've already kind of spoken about it. So obviously the first scenario is where you hit a major level of liquidity and you don't have a target anymore. The next scenario is where you do have a target, but price isn't building that buy or sell program towards it yet, right? So for instance, with this example, I literally just said to you, okay, we're at the internal and now we do have a target, right? So we have a target, but the buy program isn't forming towards it yet. In that scenario, we just wait for that buy program to form towards the target. And then we have met both criteria for the ideal conditions. And then from there, we go ahead and trade, right? So I don't think I have to cover that point too much further because I've already covered it with the other scenario. So let's get into the third one. So this next scenario is when price gets extremely choppy and it just goes range bound, okay? So let's say, for instance, we have a bullish target, right? External or internal. We're simply looking for the higher time frame buy program to run to that target, right? So we respect the FVG. Then we have this FVG or some kind of PD array that you're now expecting to propel price to form a new high. Okay, now you know that price is stuck in a range when we get what is called a failure swing on both sides of the markets, right? So when price has reacted from here, it should go and target this high. If price gets close to this high or gives a good reaction away, but then fails and comes back into the range or comes back deep into the range, that is a failure swing, right? Because price has failed to impulse above that high. And then if we get a failure swing on the other side of the market, right? So it comes down here and then it fails to take out this low and it starts to retrace again. That means now we have a failure swing on both sides of the market and price is stuck in a range. Okay. Once price is stuck in a range like that, you now have no way of knowing what direction price is going to go in with high probability. Okay. So just repeat it. The way that you identify if price is range bound, or the way that I find best, is a failure swing on both sides of the market. So price fails to get to the target, then we retrace and we fail to sweep the low, right? If price was to fail to get to the target and then it was to come and sweep the low, that's perfectly fine. If you see bullish order flow form, it's very, very easy for you to continue to buy, right? But when it fails to get beneath this low as well, price is now simply range bound. So when you see that you don't want to trade, essentially what we're looking for is for price to sweep either side of the range, right? So it can sweep the low of the range and then we'll go ahead and, continue to trade in line with our bias. If we're still expecting the target to get ran, then we will wait for bullish order flow to form and we can continue as usual, or potentially price will run the high first. If we reach the target, then cool, you have to wait. But if we just run the high and don't reach the target, then you can continue to buy. Yeah. So essentially, you want to identify the range. If price is clearly stuck in a range, then you just don't trade until one side of it is breached. Now, another example of a range bound market, rather than being stuck in a range like that, is seek and destroy, right? Where we're still moving completely sideways, but price is just taking every level of liquidity back and forth, right? So let's say we're in a sell program here. We're anticipating price to run to external range liquidity or internal, a bearish target, whatever. And price reacts away from the FVG and we form a new low. And then we retrace, but then we take out this high and then we impulse again and we take out this low. So we're literally just taking out every high and every low. Price isn't getting anywhere because if you deep it, it just looks like this, right? It's sideways price action, not getting anywhere. And it's completely unpredictable. That's the point. These range bound and choppy markets are completely unpredictable because you can't say which high is going to hold and when price is going to propel to target, right? You have to wait. So again, if you get a market like this where it's seek and destroy, you just don't want to trade, right? Just wait until price gives a solid displacement away from that area, right? The whole time price is still just bouncing back and forth. Don't even bother trading it. All right, so I'm going to go over an example of that on gold. And then I want to show you a couple of examples of how that is occurring right now in my personal trading in the live markets. Okay. So this example on gold, I really like this example because I was actually able to catch a couple trades here. And it's a really nice example. So the weekly's bullish, price retraced into this weekly FVG. I was anticipating a run towards this external range liquidity, right? Because the FVG is internal, we should now bounce to external. So I have a target and I'm waiting for bullish order flow to form towards the target. Okay, so what do we get? How does that actually start to form? Well, we take out this liquidity, we form an inverted fair value gap here. So we've formed a bullish array. So technically we're now in a buy program. We also close above these last two down candles. Okay, so that's a bullish order block. So we are forming the buy program towards the external range liquidity. So I was looking to trade. However, if we go on to the 4 hour, right, you can see that price moved into this range. Price takes out this low here, then we take out this high, then we take out this low, then we take out this high up here. Price is literally moving in that seek and destroy pattern, right, that I told you about, right? It's literally just moving sideways, taking out every level of liquidity, right? It's completely unpredictable. So I saw that and I sidelined myself. I said, I'm not going to trade. I'm going to wait for one side of the range to get breached aggressively. So that's one side of the range there. This is the other side of the range. Okay. I said, I'm going to wait for that to get breached aggressively. Ideally, we get a nice closure through the low. And we still have this daily IFVG here, right? As a bullish array. And if I play this out, you can see that low of the range there got taken out. Okay. So once we take out the low of the range, we get a nice closure. Price is no longer, just wicking the highs, right? A lot of the times the seek and destroy, you'll see it's just like a wick taking out these highs. and then a reversal, right? But we got a nice closure here. Price came into this daily IFVG, respected it, and now we're beginning to move to the upside. We have this bullish order block formed on the 4-hour, right? The buy program is now holding, okay? And once we got that, I was happy to engage again, right? It's about recognizing these conditions, waiting for them to pass, and then getting right back on it, right? As soon as price is, moving how you want it to, that's when you want to be prepared to execute, right? That's when you put your foot on the pedal. So from there, I took a couple of trades. I'm not going to go over them in this video. I just want to talk about the conditions, but I'll put the executions on the screen, right? There's 2 of them, I believe. So yeah, once we got that, I was happy to engage. And you can see once we broke out of that consolidation here, it was just a straight run to the upside. Price continued to respect that buy program that we was looking for all along, right? So that is one example of choppy markets. Now I want to show you how this is occurring in real time on Euro USD and DXY and ES. So on Euro USD, okay, price has retraced into this level of internal range liquidity, right? We have retraced into that FVG and we have this external range liquidity here. Okay, so potentially price is going to draw towards that. However, if we go onto the 4-hour or the 1-hour, it doesn't look anywhere near as clean as it does on the daily where I just marked up price, okay? If I get rid of these things, right, you'll be able to see very clearly price is just moving sideways, right? It's very choppy, very sideways. So here, price retraced and then pushed to the upside and we failed to get above this high, right? So we have this failure swing here. Then we retraced and price failed to get beneath this low, right? So we have another failure swing there. And essentially what price has done is it has built low resistance liquidity on both sides of the market, right? We have relative equal highs here and we have relative equal lows here, right? So we've built liquidity there and we've failed to get out of either side of the range. And you can see as price has gone on, it's just getting tighter and tighter and tighter in the range, right? It doesn't help that this weekend or the week of this video, the time of this video is bank holidays, Friday and Monday because it's Easter. So that doesn't help. So yeah, price is completely sideways right now. So what am I doing? How am I approaching the week? Well, I'm not trading right now. On EU at least, right? I'm not trading. The way that I will engage in the market is if price breaches this low. And then if I can continue the bullish bias, I will do that, right? And I'll get in line with that bullish order flow. Or potentially price is going to take the high first and then we go from there. But the point is, I'm not trading until we break out of this consolidation because it's very, very low probable conditions. Now let's get on to ES, okay? So ES, I had a draw on to the weekly IFVG. Sorry, the weekly FVG, my bad. This weekly FVG here, that's internal range liquidity. And for me, that was my draw. That's what I was looking for price to target. And then if we go onto the daily, okay, I'll rewind to how it looked when I was actually, deciding that this was my draw. So we had the internal range liquidity there. And price had formed this bullish order block. So we had a buy program forming towards the target. We also have this IFVG. So it was ideal conditions, right? This is what I was looking at, buy program forming towards internal range liquidity target. Very, very nice. However, if we go onto the 4-hour and look at how price started moving towards the target, you'll see how it failed, right? And you'll see why I've actually sidelined myself on this as well. Now, even on the 4-hour, it looks clean right now, right? We have this order block here that got respected. Price looks like it's running towards this high. This was perfect conditions for me, right? This is perfect trading conditions if this was to continue. But if I play it out, right, you can see we failed to get to this high, right? So we have a failure swing. Price failed to get up to that high. And now it's also retraced, okay? And currently, we haven't been able to take out this low here. So we have a failure swing here. Price currently hasn't been able to get beneath this low. If we mark it up as like low resistance liquidity, this here is all equal lows. And at the top of the range, this here is all equal highs. So we're stuck in a range again, right? Price is just moving sideways, and it is not a clear buy program towards the target, right? So it's not ideal conditions. So I've sidelined myself, right? I'm not going to try and force trades in these conditions. I'm going to wait for price to either, take out the low of the range or the high of the range, and then I'm going to engage. And, doing this kind of thing takes more discipline than if you was to just try and force trades, but it is going to protect your capital and allow you to save your trades for when the market conditions are good. Then you won't go on massive losing streaks, and you'll benefit, from bigger winning streaks because, you're only operating in ideal market conditions. Now, one thing I actually do is I post my predictions in the free Discord. So my higher time frame targets that I have, my higher time frame predictions, I post it in the free Discord. My intraday targets, how I'm actually trading within London and New York session to capitalize on those higher time frame moves. I also post that in the free Discord. So if that's something that you want to join, I'll leave the top link in the description as that. So yeah, to be honest, I think that's it for the video. Those are the market conditions that I personally avoid. That's how I operate around them in order to protect my capital. I hope you found value in this video, and I'll catch you on the next one.